Okay, we're live.
Tim Merriwood here at People's Home Equity. So we're going to talk kind of a quick thought today. There's a couple things. Wanted to do some Q&A if you guys as we go through this, but we're not going to take a lot of time since we really only come for the food. So a couple of things that I've that may have happened in the last little bit that I don't know that I mentioned to you all about is I don't know if, when we're dealing with student loans. Student loans generally, everybody's in forbearance right now. Nobody's having to pay anything on student loans, but it's a common thing when a client comes in and they've got, $20,000, $50,000, $100,000 worth of student loans, and then they're not paying on them. They're like, oh, I can afford all kinds of house, but because it's eventually they're going to have to pay something. They're going to have to pay the piper. So different loan programs treat that student loan debt in different ways. Conventional loans, there's, if you remember the Fannie and Freddie, those are the two conventional loan backers, for lack of a better term. Fannie Mae treats I think it's Fannie Mae, Paul, is 1%? Yep. Okay, Fannie Mae will look at, if you're going to do a conventional loan and it's a Fannie Mae loan, then they'll say, well, you've got $50,000 in student loan debt, so we need to use 1% of the outstanding balance as what I call a phantom payment. So if you got $50,000 in student loan, then you're going to have $500 a month. 1% of the outstanding balance is what we're going to use as a phantom payment. So if you've got that $800 car payment, and you've got this, and you've got that, and you've got another $500 phantom payment on top of that, it really affects your ability to borrow because I'm not making it's frustrating for the client because they're not really making the payment, but we've got to hit them with that. So Fannie Mae is 1%. Freddie Mac will look at it and say, well, we'll name that tune for 0.5%. So that same client now can borrow more money with a Fannie Mae product, and that's Freddie Mac. Sorry, see, Paul's gonna keep it straight. I got a little cheat sheet on my monitor, honestly, because I can't remember them. But one of them's 0.5%, one's 1%. Now, so in the past, that has been helpful, but not everybody qualifies for a conventional loan. So, generally speaking, you're going to be putting some money down, and you're going to have a higher credit score. Generally speaking, about a 700 plus credit score. I start to look at doing a conventional loan. You can put 3% down. You can put 5%. You can put as much or as little, down to 3% with a conventional loan. So, if somebody's got good credit scores, we can say, well, I'm going to put you in a Freddie Mac backed loan. And we can use 0.5% or half of your 0.5% on your student loans, and we can get the debt to income ratios to work. That's kind of our job, is to figure this stuff out. So, but for years, FHA has been 1%, period. So you got folks that are sub 700 credit scores that don't have a lot of money to put down. They're kind of stuck because you're just limited because they can't do a conventional loan. But about a month ago, maybe less, FHA came out and said, okay, we're going to change the rules. We're going to make it 0.5%. So there may be people that weren't qualified before that might be qualified now. So it's probably something we need to do. We need to go back through our database and look at those clients and see if there's any. I don't know if we have them categorized in any way that we could go do that. But so what that means is, obviously FHA, but all what I call FHA derivatives. So we've got THDA is an FHA loan with a second mortgage from THDA. So it still has the same rules as FHA. So somebody that was marginal with a THDA loan, maybe they could buy this much before, and now with the student loan situation, they might be able to, it frees up $50, $100, $200 a month because of the student loans, because we're able to go with a lower percentage of that phantom payment. There's also there's FHA, THDA, which is a FHA derivative, and then Chenoa. It's a 100% financing option where there's a first mortgage and a second mortgage. So that's for us to watch out for. But if you know anybody, we were talking about some different ones that have student loans, then that may be an opportunity. So that maybe open up some doors for them. What was the other thing we were going to talk about? We talked about deferred financing, but there seemed like there was something else before that.
Real-time area?
Yes.
Okay.
Whoever will answer. So, I'm gonna have Paul talk about the, something called deferred financing, but I just wanted to frame it. So we had somebody call the other day, and we knew that we could do this type of loan, but really didn't think about how valuable it was until, had a client call the other day and says, look, we're gonna pay cash for a house. We're taking money out. Our financial advisor says that it'd be really good to not take all this money out, because it's like a $500,000 purchase. We really don't, he says it'd be best to put the money back. So can you do financing where we can buy with cash and then get the money back out later? And we said, sure. So it's called deferred financing. Paul's gonna talk about deferred financing a lot.
So, hi, I'm Paul. I'm Paul Airwood. I'm his son and also another mortgage advisor in Tim's office. So, if there's anybody on the web. But so we talked about deferred financing, and the situation came up with, like you said, this one client that was thinking about doing that. And so I've made up a few handouts to have a little bit of information about it from what we found. Yeah, so of course this is, primarily looking at a cash purchase of the home where they can obtain, they call it deferred financing, technically an exception, in the form of a cash out refinance, to pull equity back out of the home and free up cash. So the biggest thing that we're looking at when we think of, as a selling point to you guys, obviously, we've talked, you've probably done 2 or 3 of our last few lunch and learns have included at some point getting your offer accepted, in a loan to inventory market. So, I mean, obviously a cash offer is better, or easier to go through the transaction. It's faster. Sometimes, appraisal situation's easier. All of that is simpler when you have cash. And the biggest thing is that if we could figure out a way to be able to market that for you guys, that would make it easier, I think, for higher income and for higher net worth, like we talked about, buyers. If they have that option to use cash, whether it's out of either a retirement account or a mutual fund or just straight cash from proceeds of moving from California, moving somewhere else with a higher value home, that's something that is extremely valuable, because of course you don't want to have $300,000, $400,000, $500,000 tied up in a house at whatever, even if it's right at 3% interest rate, whatever that is, it's still not making money, still not doing what you could do with, whether if you had that invested or had something like that. So
I think generally speaking that if you've got money invested, you should be making 7 to 11%, or you need to find a different financial advisor. So if the spread, if you're going to be if you're going to buy a $500,000 house, then if you've got 75% of that you can put back in the market. That might be something that would alleviate somebody's concerns about, I don't want to use all this cash, so maybe I'm going to buy a smaller house. They might say, well, if I can use this much money, but then get some of it back, then I might be willing to buy a bigger house, or might be willing to do something. So in terms of an option, that might make sense.
So, and like I said, the biggest thing that we, thinking from your point of view, obviously it's people who have cash, people who are able to make that kind of an offer, and the selling point is obviously you guys get paid quickly. You get, it's more guaranteed as far as that goes, because the cash transaction is going to go fast. I'm sure you know that. But and as far as the way we would deal with it is we could already have dealt with the customer and talk to them, figure out what their finances are like, and pretty much pre-qualify them before they make that cash offer, cash purchase, so that we know we can flip it right after and go into that. Because, like I said, it has to happen within 6 months of the purchasing. I made there's a few guidelines, a few conditions here. I mean, it has to be, like I said, an arm's length transaction. Sorry, we have to be able to document the purchase. We have to be able to show that there are no liens on it. Basically show that it is paid in full and all that to make it this simple version of a refinance. And then there's also some things that still apply conventionally. So we have to have a minimum credit score. The rates, we can only take a max of 80% LTV. So that's going to be a max of 80% of that cash that they're putting in. They're basically going to end up like a 20% down situation, but with a stronger offer. Does that make sense? Okay. So,
and then the rate, you mentioned before that the rate has, there's a sweet spot at 25% down, or, 25% or 75% loan to value.
Yeah.
The rate just gets a little bit better, but, at that point, that's a conversation we're having with the borrower.
Yeah.
What's best for them.
And so obviously, the lump can be as large as the cash purchase price or whatever they paid for the home plus closing costs and prepaids, but that's not going to happen because of the overlay rules on a cash out refinance. So that's about all we have on that. I mean, obviously, we still have to have an appraisal afterwards for the refinance, but that's something that you could would make the purchase initially easier as long as you have whatever home inspection that you felt comfortable with, things like that. I mean, it basically hurries it up and gets it sold and allows us to take our time and go through the financing deferred, like it's the terminology, so.
So like, who was it that had the one, were you the one that had the one that they offered 200,000 or bought for 200,000 over asking? Crystals. Yeah, so, I mean, that, who knows if it's gonna appraise for that? But, after the fact, if they've got that kind of cash, that's a lot of money, to be $800,000, but if you could get back 75% of that and put it back in the market or.
And even if it appraised lower, I mean, it's a cash purchase at that point, and they can, they have all that equity, whatever it appraises for, and then they can take out whatever they can,
Yeah.
So then you're not running the risk of losing the house based on the appraisal.
Yeah.
So then you can judge based on that what you can take out after the fact.
It sounds like deferred financing is just essentially buying it cash and then pulling your money back out with cash out refinance.
Yeah, quickly, yeah.
Yeah.
So it's just kind of right
Yeah,
after that. So
but
you
it-
kind of like prep them up, like, all right,
Yeah.
great, ready, set, close, all right, cool, bam.
Yeah.
Yeah, so it would just put you in the idea is put you in a better position. If you find out that somebody is a high net worth and they're like, if they said, we're just gonna pay cash for the place, then if they're concerned, if they're, in that conversation, some people just pay cash for it, which is kind of weird. Pardon me?
620.
Yeah,
What
so-
about,
preferably.
so say somebody is a wealthy to-do fella, he's retired or something, has zero income. This is rare. If there
Yeah.
was an income restriction, however, they had huge cash reserves, were able to purchase, is that gonna affect their?
It would, we're still gonna have, in the programs that we're talking about, we would have to have some sort of income. So it all comes down, what is the ratio to your debt to income? Now, there are some brokered products that we may have access to that we can, if somebody has a really high net worth, we can look at an asset depletion loan where, I've got $2 million in the bank, I don't have a job, but I'm just drawing this thing down, then we might be able to look at that. Those are difficult, and we'd rather not, if there's other options, but, in that case, somebody might just say, well, I'm just gonna buy cash. Or it might be that we could, I have to look at that, there may be, might be able to do deferred financing on that as well, so they can take the money out, pay cash, and then we could, the problem is doing some of these really creative ones that we don't do every day, like if we broker something, and having the confines of gotta get it done 30 days, right? So the beauty of this is like, okay, we're done with it, we need to get the money back into their account in a certain, 60 days or 6 months, then pressure's off, we can get it done, on a regular time. But I was thinking about the folks that came to us recently, there was something about, and I'm not a high net worth individual, I don't know all these details, but the idea was that they had 60 days they could take the money out, but they had 60 days to get the money back in, or there was gonna be penalties. So in that case, the best thing to do would, let's get you pre-qualified for a refinance, which kind of sounds a little weird, but get you pre-qualified for refinance, and so you buy they're ready, they know what they need to do, and then once they're under contract, they pull the money out, buy the house, and then we're at the same time that we're already working on the refinance. So they have to close on the first one, and then it could be 2 weeks later, we close on the refinance. So it might be, I'm just thinking, again, Paul, as Paul pointed out, we're looking at any way we can to help you guys be in a better competitive situation. It's not gonna be a lot of them, but, I'm hearing more and more people, moving from wherever, they're paying cash for places.
It helps investors too, because if they're gonna be throwing down cash, it helps for a quick close.
Yeah.
And then they wanna pull it back out, so they have more capital. to
Yeah.
continue to
Some
mine.
money,
Folks that
Yep.
use it. So that's cool to know, so
Yeah.
deferred finance.
Yeah. Is there anything else that, that is new and exciting?
Keep looking at me.
So Misty's got a new, your llama is so fat, she fell in love and broke it. I don't know what that means.
So we
anybody-
need to tell everybody in our advisors group that's not here but's gonna be watching on Facebook. This is Lucy the llama, right, Misty?
Lucy the lead llama.
Yes.
Yes.
So Tim Stout Group got it again, Matt got her again. Mike Butler had her for a while because it's whoever gives the most leads to people's home equity.
Yes.
Yes, so this is Lucy, if you haven't met her.
And she's real alpaca fur, so she's soft.
Taxidermy, it's great.
Uh,
Prettiest. They gave her some cool little extensions.
Yeah, that was Donna Lampkin,
Yes.
Keller Williams. She put the
She put
eyelashes on. Yeah, she did.
She's a taxidermist, wow, really?
Well,
So,
thank you, Paul and Tim and Misty.
all right.